All right. Well, good afternoon or good evening. Thank you so much for joining us for today's session. This is going to be the last session of our foundational option strategies master course. If you've gone through this course, and I hope you've definitely found some value in it, we're going to cover how professional traders think. So we're going to bring up some interesting studies as far as some pioneers, if you will, within the industry overall. So regardless of options like Warren Buffett and so on and so forth, and some rules that we can learn from them, in addition to what we can apply today. So we have a really great session planned for you. And if you've attended the course thus far, you should fully understand or get a really good detail on the income portion of trading the options, how you can utilize options to purchase stocks at a discount, and the leverage associated with options. So now that you know the strategies, if you will, with options, it's important to think correctly. And that's arguably one of the most important components of it, even if you think about the psychological aspect of trading and even how the Fed speaks and that can move markets. We have to be cognizant of that and really take this into account. So really excited to take you through today's session. I do have the chat and Q&A open, so please feel free to put anything in that chat window. I make sure that I monitor it and we'll go from there. So thank you again for joining today's session. And of course, before we get started, it's important to start with an important disclaimer. Know that we might use some securities and examples there and research tools, and they're for demonstration purposes only. So don't place a trade off of this. There's a lot of other analysis that goes into that before using as an example. So please know that it's not considered a recommendation by options play or a solicitation to offer buy any securities. So this is purely for educational purposes and not used for individual tax, legal, or investment advice. And then just a quick overview of what we've covered on the course schedule. And I know I talked about that very briefly, but just generating income on your portfolio with covered calls and short puts. So we started with that purposefully. So it's a great way to graduate into options if you haven't. It's utilizing those obligations that are inherent of options to define really entry and exit points similar to a limit order, and then minimize your risk with long calls and long puts, so that directional view. And then in addition to that, now we're going to go into that mindset, because when you start trading options, it is a risk asset. And hopefully you've learned that there is a long-term and a short-term view that you can use with options. But because options have an expiration date and stocks do not, you can theoretically hold them forever unless they go bankrupt. There is additional risk management that is involved with them. Therefore, it's important to be cognizant of a lot of the surrounding components of options in addition to that mindset. So that's what we're going to focus on today's sessions. I did see a message saying the recording has not been sent by email. We'll make sure that we send that out to you. So I'll make my marketing team aware. Thank you so much, Karen. In addition to that, we'll send a post follow-up email with all of the recordings as well. And then, of course, another reminder of who this is for. Know that not necessarily an active trader, and that's a common misconception with options, is because it is a risk asset, is, oh, it's something that's very complex and is an active trader. And that's not necessarily true. It's quite often that anyone who's trading, you can utilize options, like I said, in either one. So it could be from an active trading perspective, which again is more risk associated with it, but it's also a process that you can utilize with your long-term portfolio, as long as we understand the education around it, which is extremely important by following those simple rules for consistent income, which again, we already covered and can touch base on. So as far as what we're going to cover today is we're going to take a look at the strategy or psychology, if you will, within the market. That's extremely important. And then we're going to have some lessons from the pioneers. So I pulled a couple of my favorites. There are certainly a lot that we can go through. However, we're going to analyze what's made them so successful and how can we apply that today. Then we're going to look at our behaviors. So our behaviors as human beings, if you will, and how that translates over to the trading aspect of the market. And we'll talk about optimal position. How can we apply all of that to get into the right mindset, and of course, save time for questions and answers. But really what I want you to keep in your mind is, what does it take to become a profitable trader? So let's start with this chart. I love showing this chart. This is a monthly view of the S&P 500 from 1925 to present. And you can pull this with any major broad-based indice and see something very similar. And this is the purpose of showing you this, is whenever you start investing, options or not, you have to understand that not only are you investing dollars, which is something that you could risk. So you're risking, if you buy ABC security, whatever that amount that you're investing, that is how much you could potentially lose. So you want to make sure that you have a good stock picking process and so on and so forth. But in addition to that, you're also accepting volatility. So if you have investments with property, for example, that's not appraised every single day. So we can definitely see what's happening with the housing market, especially now. However, you don't have a clear view into that price of that asset so consistently because it's not traded on the secondary market. So therefore, that view or that information is something that can help us. However, it's something that we also have to accept and not allow us to hinder us. Use that information to make us better, not to feed into the mind. So for example, this chart is showing you the cost of your mindset. If you're starting investing right now, and you'll see that I've got it listed as mistake, and meaning as in this is the perception, if you were to invest right before the 2001 decline or the 2008 COVID here even, or of course the peak of 2020. If you were to invest in those timeframes, you may feel like that's a mistake right away because there is a massive decline that you're going to experience in the market. However, if we were to zoom out and take a look at this picture, it's actually better in the long term. But what we need to understand is how to capitalize on that. And it is very, 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 very common to have well, I guess common maybe is a poor word there, but bear markets are going to happen. They happen when there are issues. This is more global, the supply chain issues, things of that nature. But with bear markets, there are also bear market rallies. There actually is on average about 10 to 5% bear market rallies within each major decline. So these are things that we have to be important of, is the movement of the market. So that's that volatility that I'm talking about, that we accept. And now that we're layering on options to our process, the beauty of options is they can be profitable in any type of market, bullish, bearish, or neutral, as long as we understand them and know how to layer them accordingly. Now, if you were dealing purely with just equities or stocks, oftentimes when there is a market decline, you'll hear dollar cost averaging. So reducing the basis of your position as you add onto it, as it's something that you are bullish on in the long term. So you are expecting that capital appreciation. So that's where I invite you to think about the previous sessions where we talked about selling puts to buy securities that you are bullish on in the long term. Something does happen in bear markets where options experience a uptick or a bigger move in their extrinsic value through implied volatility. And that's because implied volatility, or that volatility that we experience in declines, is heightened in declines. And that's on the call and the put side, because implied volatility by definition is the market's likelihood movement of the underlying security. And in a bear market, that we're trying to digest that valuation of an underlying security, and therefore that digestion period is a little more volatile because of those external macro headwinds that need to be resolved. But as options traders, that is something we can capitalize on. So if we know something's expensive, it's optimal to sell, and if something is cheaper, it's optimal to buy. Things tend to be a little more expensive from an option perspective in the bear market, but it certainly varies in that. But those are things to be cognizant of and really understand. But what I want you to take away from this view is, even if you start trading and you experience a massive decline, know that if you look at the bigger picture, it turns out all right at the end. And so that's important to just think of as we go through the next slides. Now, this leads me to the pioneers. So I've got Warren Buffett, and I'm sure we've all heard of Warren Buffett. He is arguably one of the best investors or stock pickers of our time. chairman and CEO of Berkshire Hathaway. He's been investing since 1941. So notice the times I put on here. Dennis Gartman, he is a famous economist, calls a lot of the economy views, and he's been investing since the early 70s. And then Bob Farrell, my personal favorite, head of research of Merrill Lynch. So he gave us something called the Bob Farrell rules. I encourage you to search that. They're really great, that he put together and have been still applicable even for the past 40 years of how markets work from a technical basis. So he's one of those early technical analysts within the market that really changed technical analysis. So there's a lot that we can learn from these three pioneers, and they have been investing for quite a while. And I know that's extremely important, is to learn from past events in the market, but also past people who have studied the market and apply those. But we also need to modernize them as well. And so we're going to go through that today. So let's start with Warren Buffett. So rule number one, and I love the way that these are positioned, if you will, is never lose money. And rule number two, never forget rule number one. So what does he mean there? And it's important to kind of digest that, if you will. What he means is, or one of his other ones even, is be fearful when others are greedy and greedy when others are fearful. But what he means by don't lose money means whenever you are buying a security, he goes into quite a lot of details, meaning he even looks at the operating management of that security, down to the detail of, oh, are they thinking about how many paper towels they use, or that shows management and attention to detail. So not only does he want to look at the valuation of the underlying security, he wants to understand from a management perspective if it can grow. And what I dissect from that is when we say rule number one, never lose money, that simply means do your homework and do your research and get educated. And then rule number two is don't forget rule number one, which means have that process of doing your research, understanding the underlying security that you're investing in. And then we translate that to options, which means understand the strategy. You add a layer of complexity that can absolutely benefit you, but it's very important to understand optimal outcomes, optimal environments, which these strategies can be initiated. And that's what the options play tool is designed for. It scans those things for you. So we definitely have something that the Warren Buffett didn't have for that in that regard early on in his career, which is the influx of technology, which we'll certainly talk about in a moment. Now, he personally lost, I think it was about 23 billion, so quite a bit, in the financial crisis of 2008. And that's when his company, Berkshire Hathaway, lost its AAA rating, but that was a mortgage-backed security crisis and something that we don't want to go into too much detail. But what he means is just don't gamble, don't be frivolous, go in with a cavalier attitude. You can't go in saying it's okay to lose, but you have to accept that risk, but you have to do your homework, do your research. That's the important rule that we can learn from one of these famous Warren Buffett quotes. Number two, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So meaning this translates into technical analysis in the way that I view it nonetheless. He's a value investor. He likes to buy stocks that are at rock bottom. And the way we can find that is through valuations, the way you look at PE. There's a fundamental way to screen for that in addition to technical analysis. So it's another aspect of doing your research and understanding valuations. And options play, the tool itself, has ideas on that first widget found on the left-hand side. He is focused on the long term, though, and believes in the power of capital appreciation. So Warren Buffett actually started investing when he was 11 years old, which is amazing for someone in his time, but he believed in the value of capital appreciation. And that's something we can apply to options when having the income stream, is capital appreciation by adding additional income layered on to our portfolio. We have underlying securities, or utilizing puts to buy those securities and then calls to subsequently sell those securities. So this is just another layer of doing your homework, but look for value that can give you capital appreciation over time when choosing your underlying securities. So let's move on to Dennis Gartman. So his is rather more straightforward, and I won't spend as much time on Mr. Gartman here. He says, be patient with winning trades, be enormously impatient with losing trades. Remember, it's quite possible to make large sums trading and investing if we're right only 30% of the time, as long as our losses are small and our profits are large. Now, this is probably one of the most valuable quotes that I have on the screen, and we'll talk about this in more detail, but it's about risk versus reward. So think about whenever you, there was a great study by, I'm not sure which firm, but one of the big four, where it's decision making. So in order to make a good decision, experience is involved, because then you understand outcomes, but you also have to skew your risk versus reward. So we're going to talk about that in a little more detail in a moment, but that's what he's saying here. Be patient with winning trades and enormously impatient with losing trades. So that's that process. And anytime you make a decision, and I'm sure you've done this in your life, whenever you've purchased a new home, a car, a watch, a purse, at least my process, you do your homework. If you are spending your money and making a really big investment, even from a home, you understand that it's the area that you want to live in. Maybe it's you want to be closer to your family, or there are some reason for you doing that process. Then you're going to think about the interest rate environment and the finance aspect of that. And if that's where you want to grow your family, or maybe it's short term, there is a lot of thinking that goes into that. And that translates to a car. Is this right to fit your needs, and so on and so forth. And that is what Dennis Gartman is telling us here, in addition to Mr. Buffett, is that process is extremely important, and decision making is extremely important. They should be calm, collected, and calculated. So that patience aspect, and that's where your mind gets in the right place. And if you've made those bigger decisions and you've done anything without being calm, collected, and calculated, I'm sure it didn't turn out as anticipated, because you didn't do your homework. And that's what I want you to take away from this. And of course, risk versus reward, which will relate to the trading aspect in a very brief moment. So let's talk about Bob Farrell. And again, this is the technical side of those pioneers. It says, fear and greed are stronger than long-term resolve. So again, that's an emotional aspect that comes with the market. And if you go back to that slide that I showed you initially, when the market goes down and you're investing in that point, fear and greed, just like now, the volatility in the market is ever so heightened. We make rapid declines and then rapid increases, and that tends to move around. And one of Farrell's rules is even focusing on a trend isn't true if it's narrow, and stronger if it's broad-based. And we can apply that to quite a bit of information, but meaning if, at least from the US side, the tech sector, because of the strength of the US dollar, takes, because the tech sector largely has international exposure, that is the biggest hit. So as the dollar goes up, the tech sector goes down. Well, the tech sector makes a huge component of the broader base market. It's about 30%, but that's a narrow view. If you go to the broader view, it is bringing down a certain component. And then that's how you can really apply to sectors and the business cycle and so on and so forth. And then his last quote that I will share with you today is, when all the experts and forecasts agree, something else is going to happen. And that's really speaking to capitulation. So that's something that's been spoken about quite a bit, is looking forward in the market, is that agreeing moment of all the sellers are gone. And if all the sellers are gone, then that means there's an influx of supply. And at some point, that demand will pick up. So it's that balance that really shapes technical analysis. But what this also tells me, besides being a contrarian, is homework is extremely, extremely important. And you cannot allow your process, I mean, your process isn't a process unless it's performing, but your process has to be defined, and you can't allow the emotional aspect of everyone around you, because that fear and greed and volatility can be absolutely a scary thing. Redefine your process. And we'll talk about how we can apply this now that we've got a good understanding of that. So this is where I love to share that chart once more and notice that I had the pioneers and when they started trading. So this is the advantage that you have. They're the big mechanism that I hear within the market is always get passive. You know, you start investing, you end up just mirroring a market of some sort. And then there was this layering in of get active. So those active traders started coming in. And this really started probably in the early 2000s and then picked up, I want to say, into the 2010s. But now that we have this influx of technology, so you can see on the screen how much technology has changed since these guys, the pioneers, started in their process. My mission to you is get engaged. Now you have technology on your side. You don't have to do a point and figure chart. You can just pull a chart and get that data and utilize the tools and resources that are around you. And our tool Options Play is one of those designed to optimize your trading process. And there are so many out there that are available to you just to understand valuations. You don't have to read research reports. You can pull analyst opinions. There's just a lot that's in front of you. So what I want to make sure that you know, your advantage that you have to these pioneers and wonderful traders is the technology that's around you, the access to information. But that access to information, just like we're experiencing in this market, is creating more volatility because now we have the opportunity to react early and often. But let's just be cognizant of that and do our homework and apply that to our process. So let's talk about application. So the profitability of trading, it's something that we want to focus on. And this is really the centralized message of today's session. It's better correlated to behavior over intelligence and access to information. So we have access to information, and that is helpful. And it's kind of like that study that says IQ skills will, I think it was in the executive world, EQ, so the emotion quotient, will get you higher and climb up the corporate ladder or more successful via these studies more than IQ. And that's process, being able to read a room, being able to adjust. The same applies here. It's your behavior and your process. And ideally, you want to marry both so you have access to that information. Let's utilize that to define our process, make it a disciplined approach. And that's going to certainly help. Probability and winning are correlated, but not as strong as most investors think. So this is a wonderful common misconception, especially when it comes to trading risk assets or trading in general. So very different from the investing space. If you are profitable, it doesn't mean that you win on every single trade. And it also does not mean that you win on the majority of your trades sometimes. But what it does mean is you understand how to skew risk versus reward in your favor, which we'll talk about in a brief moment. But in short, whenever you are creating an options trade, long or short, you want to make sure that the risk to reward ratio is skewed in your favor. So if I am spending 300, I want to make sure that I can make 1200. So that's a 3-to-1 on the long side. And then normally the inverse on the short side, because the long side profits from being largely directional. You need a sharp move to the up or downside, just depending if you're buying a call or a put. Whereas on the short option side, you could be neutral or bullish in the case of a short put. You are profitable as long as the underlying remains 1 penny above your strike price. So that means I don't need a large movement. And then the inverse is true with the short call. You're at max profit if you are at just 1 penny below your strike price. So that's why I'm saying not largely directional, and why risk versus reward can be skewed for those. And what you need to focus on is learning and honing the right skills. So on the investing aspect, or choosing your underlying security, that's utilizing the information available to make sure that it is the right trade and what you want to invest in. From options, that is education. Knowledge is power. It is knowing where you feel the underlying security is going to go, what strategy best suits that type of environment, And I just gave it to you there from the individual leg perspective. Long options, sharp directional movement. You need to make sure that you expect the underlying security to move a lot to be profitable. Short options, you're just neutral to one side or the other. So very little movement is needed. So knowing what environments are suitable, and then that goes into the premiums, like I was saying earlier, when things are more expensive, when do I sell? If things are more expensive, though, it's because I expect a likelihood movement of either direction. So sometimes the long option makes sense. So it's just knowing how to read that. We do that in options with something called IV rank. So anything, if you notice something on IV rank, when you put in the underlying security on the options play tool, you'll anything over 50 indicates it's more expensive. Anything below 50, it's less expensive. But know that IV rank is based on a 30-day period. So if you adjust your options, just be cognizant of that. But this is what I'm speaking of as far as honing in those skills. So let's talk about account blowups and setbacks. So what happens, and this goes into your risk versus reward, is trading too large will blow up your accounts. So there is a good rule, which we'll talk about in a little more detail, is trading small and trading often. And you need to know what amount you're willing to risk, but you do not need to trade your entire portfolio. Generally, the rule is about 2%. That's the rule that I personally follow. That can be adjusted based on your risk tolerance. But if you have 3 trades with a 3-to-1 ratio and you lose 2 of the 3, you're at break even if you follow that rule. But if you've used your entire account, you don't even have the opportunity to do that. So that's what's extremely important, is that is how I've seen it so many times. People will blow up their accounts and because they're overextending and they're not diversifying. So diversification in the investing world means various asset classes and various sectors. That way you're not relying on one particular thing to be profitable. And the same applies for options and trading in general. This presentation you can apply to trading with just stocks. It's if you put all your eggs in one basket, and that's inclusive of one strategy, or you're sure you could potentially make a lot more. However, you will definitely or could potentially make a lot less. And if that occurs, then you're out of the game, and that's not the goal here. From thinking about the mindset there, we know the best course of action, but rarely take it. And these are behaviors based on a lot of studies, and it's the emotional aspect. And think about going to the casino, if that's something you've done. We don't want to gamble. That's not what we're doing. And there is a strategic process that goes into if you are even gambling efficiently. So knowing the best course of action and staying to your disciplined approach is very important, and you cannot allow those external factors of the worst thing that can happen is you start trading options, you use way more than 2% of your account, and then you make a ton of money. That's great, but this is why it's the worst thing that can happen, is because now we say, oh, actually, I can do this, I'm really good. And then you lose your next one, and then you're done. That's so I hate it when people trade for the first time and do really, really well for that purpose, unless they're thinking about it this way. I definitely want everyone to do really, really well. But the purpose of telling you that is you have to only use a small portion of your account to prevent blowing up and just losing absolutely everything. Because again, it's a risk asset, but we have to skew risk versus reward in our favor. And then we skew probability in our favor and probability of success. And if you've studied those, now we are absolutely setting ourselves up for success. And the solution seems so simple. It really does, but practice is a little bit harder than that, especially when you're experiencing movements in the market. But it takes time to learn how to overcome behaviors, especially if they're ones that we already have, which these are certainly some behaviors that a lot of people already have and have to shift within the way they apply it throughout their entire process. I think it takes, 21 days before something becomes a habit, doing it consistently. So just think about that. Stick to your rules, and you will definitely put yourself ahead. So let's go into the golden rule of trading. So I started with it, but I want to make sure we give you a value, and I apologize that this is in dollars and not krona. So risk management, like I said, 1 to 2% of your portfolio. If you have a higher risk tolerance and that portfolio is growing from other means, then feel free to adjust. But it's important to be able to utilize that risk management. That way, if you do experience a loss, you have enough trades to overcome that, in addition to the risk versus reward that is skewed in your favor. This then allows smaller losses easier to accept, so you don't double down. That's what we want to prevent and let go of, because that disciplined approach is extremely important. Now, at Options Play, with every strategy, we associate best practices with them. So when you should exit, and that is on the profit side and on the loss side. And with options, this is a nugget. One of my members told me this over in Canada, and it was a wonderful thing that now I say almost in every webinar, is not holding an option until expiration. So he came up to me and stated that he never realized that until attending our sessions. And so I want to make sure that I reiterate that, because it's something that may seem very obvious to me, may not necessarily be, because remember, I do this for a living every single day, whereas you're a master in your craft, whatever that may be, which you should definitely apply to trading as well, whole different discussion. But holding an option till expiration also is in a way of associated risk, and that's important within your process. Now, if you are utilizing options to buy and sell stock, different story. But if you're on that trading side of it, holding options till expiration, if you're long, means you're going to lose any extrinsic value that you purchased. So that time decay is going to go away. And that means that you're less likely to be profitable if you are buying options. If you're shorting options, especially if the underlying security is really, really close to your strike price. So recall how I said for a short put, for example, you are neutral to bullish because you need the underlying security to be just 1 penny above your selected strike. So just a fraction. If you hold that till expiration, now you have what's called gamma risk, which is directional risk, whereas that underlying security can move very quickly, in which case you could be unprofitable really, really quickly. So that's why we don't hold options until expiration. So back to the golden rules, is smaller losses are easier to accept when you have traded a small portion of your account, or if you find yourself holding an option till expiration because something happened, it's still easier to accept that because it is a smaller portion of your account and not your entire account. And this will, out of anything, prevent your account from blowing up and will make you more profitable, is because you're allowing yourself a cushion. We talk about in this environment how it's so important to have a profit margin when you're buying securities that in a high interest rate or high inflationary environment, because profit margins are that cushion where if you are experiencing less revenue, you have a savings account essentially that you can dip into. That's the same rule is applying here. You need to make sure that you have a cushion. That way you maximize your profit potential. And let's give you another quote here, or from a famous trader, finite versus infinite games. So know with your finite game, your goal is to win, right? There are fixed rules. It ends at a certain point. There are winners and losers. So think basketball, football, chess. We know specifically what's going to happen, zero-sum game, if you will. On the other side, your goal is to stay in the game. And that's what we are focusing on from a professional trader's perspective and the psychological aspect. There aren't any agreed upon rules. There are certain mechanics and headwinds, but things change. Think about the influx of technology. That absolutely changes so much, especially when we think about current macro environments. And the true comes from the trading aspect, is That changes, so we have to be able to adapt, meaning the market changes. Therefore, we adapt accordingly and execute accordingly. We find those optimal environments. So it's never ending, but in order to make sure that we stay in that game, we use that small portion of our portfolio, the 2%, to ensure that we've got optimal opportunities, especially executed upon when they arise. So this is where you're a player, and that's made up of players and dropouts, but we want to remain a player and not a dropout. Very similar to running a business, climate change, and trading. You adjust as things move around you. So even think about the seasonality of the market or around you. When autumn comes around, we're adding sweaters, we're adjusting to our temperatures to go on without our normal lives. The same applies with trading. We adjust and address accordingly and are constantly learning. There are new products that come out on the market, new technology, rules change. So that learning aspect is extremely important. And one of the items that I really love very much about the market. And I've said this over and over, but of course, when I provide you a visual, is your probability of profit must outweigh the risk that you are putting in with your trade. And that will absolutely allow you to be more successful, especially if you do a contrarian view or whatever your process may be, and you're on the riskier side. So even if you can layer risk upon risk upon risk, when that happens, think about risk versus reward. You are absolutely will make more money when you are risking, but you will make so much more money if you think about risk versus reward. So if I'm spending $300 to make a trade, I want to make sure that I can make $1,200 off that. That's very important to maximize your success. And you can see, if you do the math as far as probabilities, think about flipping a coin, you'll do so much better if the reward is skewed in your favor. And the last slide I'll share with you, and we'll go a little more in detail. And might I add, on the options play tool, there is a setting that you can add where you could only put 2%. It will only show you can put a portfolio value and a percentage, and that is the maximum amount of risk that it will ever show you. There's probability of profit that's displayed, and we can go through that as well. But what I want you to take away from this in the mindset is to get engaged. So when you get your head in the game, risk and success, they go hand in hand. And investing absolutely means accepting volatility. But let's understand volatility and utilize it to our advantage. Anytime you take a risk or make a decision, should be calm, collected, and calculated. You should define your process absent of emotion. When you bring in emotion, then you're not thinking properly. That's also a scientific study. It's something that I have an 11-year-old, and we are dealing with those changes. And it's something I've talked to him about, is when you're yelling, your central cortex here starts overtaking your mind. And when that happens, you're not thinking properly. And when you get out of that state of mind, all of a sudden, in hindsight, you realize the consequences and the negative outputs of your actions, but it's not happening in that time. But what we can do is be cognizant of our emotions and then remove ourselves from that process when that occurs, because we want to make sure that every decision is calm, calculated, and collected. And if you apply that to every aspect of your life, you'll be very successful. So that's extremely important. And that's what I mean by getting your head in your game, is doing your homework, making sure that you do your research, know how everything works very well. And that's going to define your decision-making process. Now you have data and reliability and understanding, and that's going to build confidence, in which case you can execute upon your process utilizing the rules that we talked about earlier. Number two, and poor words for this time, so I apologize, is lose a battle and win the war. And this means focus on your long-term strategy and creating that positive risk versus reward profile. Know that you're not going to profit on every trade. Absolutely not. I certainly don't. However, my risk reward profile is positive. So when that does occur, I'm okay with it because I know that I'm making more on the trades that win than losing on the trades that lose, which is really the key to success. That's it right there. It's so simple. And knowing that your portfolio will grow over time with rational risk taking. So that goes back to what we've learned from Warren Buffett and really the power of investing, which is compound interest. Compound interest is a beautiful thing. You can make so much money from understanding compound interest, and that's how you grow wealth. And it's generational wealth, and it's wealth that grows over time. And we can amplify that by that yield that options bring us from the sell side, and then of course from the directional trades as well, is reinvesting those profits and adjusting. So your 2% that you're utilizing is going to grow over time, and that is how you can utilize the power of compound interest. And that focus and being strategic, just like you would with running a company or thinking in strategy overall, is that focus on the bigger picture, but of course the details of the smaller items. And then last is the mistakes are growth opportunities. And this is where it's also a psychological aspect. And this came from a book I read, is optimistic narratives are slow and pessimistic fall quickly. So think about that. Oftentimes, even with the market, I think there's that saying, it's been adjusted, but the one that I recall is you fall down the stairs, but you climb back up them, meaning this decline is rapid and quick. And that's true if we were to go back to that earlier slide of the overall market, which in fact I will bring up. Declines are rapid, very, very rapid, whereas the inclines are much slower. So this is a fall down the stairs and then a rise up. But if we layer options into our process, we know how to make profit in these type of environments, and that those are opportunities as well. So that's extremely important to be aware of. And compound interest is powerful. They, just like I was saying, markets fall fast, but they rise slowly, and you must fall forward to go ahead and learn from your mistakes. This all really goes together when you have a trade that isn't profitable, and even if you've used your 2% rule, that's where it's just a great learning opportunity. You take a step back and say, okay, why wasn't this? Was it the underlying security? Was it timing? What happened there? That can help you redefine your process. And when you make those decisions and redefine your process and use the tools that you have to be engaged, then you will absolutely optimize your success. And that's really what's very beautiful about the power of options. And when you implement a trading strategy, is the engagement that is there, and the what you can really do when you understand options. So I definitely thank you for joining today's session and spending the time and going through this entire course to understand how options work, inclusive of your trading mindset, which is extremely important. And like I said, this presentation even applies if you're just trading stocks outside of options, but it's really important from trading in general. So I hope you found value in today's session. So I thank you for that. We do have about 14 minutes. So if there are any questions, please feel free to put them in the chat window or the Q&A. There will be an email with this recording sent out. Usually takes 24 to 48 hours. We try to get it a lot sooner. But of course, that will be coming in your email. All right. Okay. Is it possible to sort out options by implied volatility? All right, so there's a couple there. There certainly is. I can pull up the tool as well. So when you have our screeners that pull optimal strategies, so credit spreads, the cash cover puts, the covered calls, you can sort by implied volatility there or IV rank. So, and I prefer IV rank, and I will tell you why. Implied volatility is something that can be so specific to that security. So what immediately comes to my mind is Tesla. Tesla is so volatile because Elon Musk can tweet something and then all of a sudden it moves. And so it's also just a highly traded security. So that always has high IV. And that's just inherent to the security. IV rank will tell me, is it higher than what it normally is? So an IV rank that's over 50 means it's higher. And if it's below 50, it's lower. So you can certainly look at IV, and I think that's extremely important. But IV rank is a great way to see if something is more expensive or cheaper, if that's the goal of you utilizing IV. But just like a spreadsheet, you can sort through it. And advice on reading up on more advanced option strategies. So this is where we definitely have these sessions with Nasdaq Nordic, and we will certainly do more if we want to expand them to the advanced realm, which I'm absolutely happy to do. But our YouTube channel and the Nordics YouTube channel as well, we house a lot of these where we go through so many advanced strategies. And that's where it's extremely helpful to go through that. We're looking to have more content and courses, but I really like to utilize the tool as well, just to understand advanced strategies. But the way that we teach it, I've been doing this for almost 15 years now, and I've spent a lot of time in corporate America and on the back end and building these systems for a lot of clients. And the way that we teach it is utilizing strategy drivers. So for example, a long call, the driver is the long call, but when you graduate to a bull call spread, the driver is still the long call because it's a directional play. So you need to know those individual legs, which is what this course was designed for. It's for you to know those 4 individual legs really, really well. And once you know that, advanced strategies are literally an extension of each individual leg. So long call, the next layer onto that is a bull call spread. And all that means is I'm capping my profit potential. Inverse is true for the long put, you're capping your profit potential to the downside. For the short calls and the short puts, you're just mitigating your risk. So for a short call, you are obligated to sell the security. That obligation kicks in when the call has value, which occurs when the underlying security goes well above your strike price because it contains the right to buy a security. So the way that I would mitigate my risk with a short call is by creating a short call spread or a credit spread, bear call spread, lots of names, with a predefined buy point. So that means if the underlying security moves against me and goes above my strike price, I limit to where my losses will be. So that's the way advanced strategies work. And then of course you can take the 2-legged strategies and make 4-legged strategies, but that's the way you graduate it. But that's the great way to get your mind thinking mathematically and the right way. Options they can literally be named anything. And it's just, if you understand what each individual leg will do in that environment, you're going to be really, really great. And thinking about books, I wish there was a good book. I've gone through a couple and I don't see any that teach it well. So I don't have one that I'm going to recommend. And the only one that I found was Options Edge, but it goes through the actual math calculation. And I just think it's full of useless information and doesn't get your head in the right spot. So I'm gonna go, maybe I'm biased because I've created those, but the videos that we've created, I think put it in the right place. And that perception, perhaps we should consider a book. If I change expected price of an underlying share, profit change of the trade, but it changed implied volatility, nothing happened, why? So your implied volatility, that should adjust, especially if you move it up or down, because that's gonna make your premium more expensive. So that should absolutely make an adjustment. So let me bring up the tool for you. Give me one brief moment. Okay. All right, while I'm pulling that up, let me look at another question. Yep. And I see another question as far as you missed the first session. We'll make sure that we send out a follow-up email that has every single course within these sessions. That way you have access to everything. All right, I don't know why that's working. I have to shut off absolutely everything when I live stream, so I apologize. I can't pull it up right now. But yes, when you change the underlying security, it should make an adjustment to implied volatility, unless the only reason it is going to do nothing is if you're at your max profit point with the price that you chose for the underlying security. Therefore, there is nothing more it can do, no matter how much more the option goes up in value. It's not going to make a change. So I would definitely check that, and that's probably why it's not moving. So if you have a multi-leg option up, and I'll use the bull call spread, for example, max gain is going to be at that higher strike price. Even if you move implied volatility and you have the underlying security past here, it's not going to make any adjustments. All right. So this puts us relatively close to time. I appreciate the questions and engaging conversation. And again, I'll make sure that we send out this session in addition to previous sessions via email. But thank you again for the time today and investing in that knowledge. I hope you found some value, and I hope everyone enjoys the rest of their week.